welcome to FX Street. Today is Wednesday, December 10th, 2008. It's 8 a.m. Eastern. Welcome one and all. Great to see you here. Welcome back to FX Street. Great to see such a big crowd. Today we're going to have a very fun time, I hope, talking about range-bound and trending market conditions. It's one of the most basic tenets of technical analysis. By the way, if you can't see the charts at any time, please let me know. I'll refresh the camera on my end. So one of the basic tenets of technical analysis studying charts is to differentiate between two different market conditions, one being range-bound and one being trending. We'll define each one, and then we'll find a number of examples of each type of condition and how we trade them. If you have any questions, chat them in any time. Now, a range-bound market is a market that fails to make new highs or new lows and tends to stay in a range. We use a buy low, sell high type of approach. If you look at the chart, the bottom right-hand corner, we see a little consolidation pattern here where the market failed to make new highs or new lows, and that's a range-bound pattern. Now, the opposite is a trending market. The trending market, or the market with a trend, has a direction. Trending markets tend to make new highs and new lows rather consistently. And in a trending market, we can use a buy low, sell high approach, but it's important we only trade in the same direction as the overall trend. Meaning in a range-bound market, and we'll define it here, how do we know it's a trending market, first of all? Well, we draw our support and resistance lines. Resistance is important in a downtrending market. That's our ceiling, because that tells us the next time we can sell short, trading with the trend, in this case to the downside. Support is drawn by connecting parallel or similar lows, not parallel, but similar lows. Sometimes the support and resistance levels will emerge in a parallel fashion, which is helpful. Okay, so that's a trending market condition. It's not a very good example because it didn't give us a lot of opportunity to get involved, but we know it's trending because it continues to make lower lows and lower highs. Now, alongside with technical lines like the support and resistance trend lines, we can also use a number of different indicators to tell us whether we're in a trending or a range-bound market. One are the Bollinger Bands. Okay, the Bollinger Bands, the center line is a 20 simple moving average, and the Bollinger Bands are set two standard deviations above and below that center moving average. Now, in the trending market condition, you'll notice a couple things. First of all, the market tends to stay between the center line and one of the Bollinger Bands. In this case, a trending market to the downside, the market tends to stay between the center moving average and the bottom band. If we were to look, and by the way, this is a euro-dollar chart, if we were to look at an uptrending market, we would see the market has a tendency to stay between the center line and the upper band. Now, what's the difference? A range-bound market, the market tends to go above and below the center moving average, the 20 simple moving average, center line, quite often. That's a very easy way to determine, are we in a range-bound or trending market? Range-bound markets, again, tend to go back and forth above and below the simple moving average. In the trending market, well, we tend to stay on one side of the moving average, either to the downside or to the upside. Let's take away the Bollinger Bands. I'll show you some other indicators that we can use to define whether we're in a range-bound or trending market. We can look at the Relative Strength Index, RSI, measured on a period of 14. We can find that the market will, when the market is in a trending market condition, when we're making new highs or new lows, the RSI has a greater tendency to fall below 30 or cross above 70. Reason being is because the market only, or the RSI only crosses below 30 or above 70 when there's a real tone, a real strength in the markets. Well, during range-bound markets, the market pattern tends to get very, very quiet, as we can see over here, and then later on, more recently, euro-dollar was in a range-bound market and we failed to make new highs or new lows. In fact, if we use an RSI and we're trading a range-bound market, well, we know that if the RSI crosses above 70 or if it crosses below 30, then it's time to get out of our buy low, sell high type of trade because the market has a greater chance to break out one way or the other. But we're going to take away this indicator and We're going to start very, very basically. How do we define the markets and how do we place a trade? Well, the trending market, taking the more recent trading action, trending markets moving to the downside, we draw a resistance connecting significant highs. And I think it's important to always draw these lines in terms of the direction of the market. Meaning, again, if the market's going down, I want to sell short. I don't want to buy. I want to sell short. Well, if I sell short, I want to do so as close to the high as possible, as close to a resistance as possible. That's why resistance is important in a trending market condition, in a downtrending market condition. If the market moved back to the upside, create a new trend to the upside, well, then I'd want to draw support first. Now, to draw support or resistance, we simply draw lines connecting significant highs or significant lows. We want to connect at least 2 significant highs or lows. The third one is the test. So we can see over here, we drew this line starting the highs of 147.67. That's back in September 25th on the euro dollar. Imagine that. We came all the way down and then rallied back up and then retested this line at 137.69 on October 14th. Well, we didn't know that was going to be the high, but then subsequently we can see 1, 2, probably 3 times the market most recently gave us a chance to sell short right around 134.60, 134.61. Well, from that point moving forward, 134.61, the market actually dropped down to 123. That doesn't happen every day, but it was a really nice move. Now, in addition, we want to place our protective stops above the resistance level at a point where we don't think the market's going to go to. So we can see the second line that I drew, and I'll change this color to red to show the stop order. We'd want to sell short near the white line and place a protective stop order near the red line above the highs at a price level we do not think the market can go to. And that's really what's important, is to place a protective stop orders logically an area that we do not think the market's going to go to. Now, eventually, the trend ran out of steam, and we began a range-bound market. Range-bound markets, we draw support and resistance in the same fashion, connecting significant lows to significant highs. Notice in a range-bound market, we have a triangle consolidation pattern. This is the change, and this is, I think, what hurts a lot of traders is differentiating between the change from a range-bound to a trending market condition. Again, in a trending market condition, we can use either a buy low or sell high approach, but only in the same direction as the overall trend. In this case, to the downside. In a range-bound market, we can use a buy low, sell high approach. We can buy and sell at different points with less of a chance of being stopped out because we know the market has less of a chance of breaking out. Now, if we were to apply our indicators, what do we say? The Bollinger Bands, right? Well, notice the Bollinger Bands, the market stayed below the center line during the trending condition. But eventually, as a range-bound market developed, we crossed above the center moving average and hit our upper band. Now, the upper band, we know where that's going to be. The upper band is always 2 standard deviations above and below the simple moving average in the center. Now, to use the moving averages in a range-bound market is very simple. We should apply a very simple buy low, sell high type of approach. In other words, cross below the lower band and then wait for the market to cross back above the lower band, and then we can go long, placing our protective stops below the recent lows, below those lows that were achieved when the market hit the lower band. Now, we sell short, same thing holds true. Wait for the market to test and cross just a little bit above the upper band, and then wait for the market to dip back below the upper band. In that case, we'd sell short with protective stops placed above the highs. And we can continue to do so over and over again as long as the market stays within a range. Taking profits, I like to take profits right in the middle at the area where we think the market has the greatest chance to return to, which is a center moving average. By the way, if you have any questions, do not hesitate, chat them in any time. We're more than happy to adjust them. If there's any currency pairs that you'd like to see, I have access to a great deal of them. I'll be more than happy to pull any one of them up. Question is, Adam, are you using an oscillator as well, like RSI or CCI? Well, it's a great question. What I would say is use one oscillator. An oscillator is an indicator that just measures the market's movement from up to down, down to up. That could be the RSI, Relative Strength Index. Could be the MACD, Moving Average Convergence Divergence. Could be the slow or fast stochastics. Could be the moving average, not moving averages, but the Bollinger Bands. It could be any one of these. I would not use more than one because, well, very simply, they're kind of duplicative. See, all technical indicators, at least oscillators, tend to measure the market under the same criteria: price over time and volatility or oscillation at times. So to use the RSI and slow stochastics and Bollinger Bands, I think it would give us not necessarily false trade signals. I think it's over-convincing, though. When you see the RSI and the slow stochastics and they both tell you to buy, you may be convinced to buy. Well, the RSI and slow stochastics oftentimes will give buy signals at the same time. They measure basically the same thing. What we want to use is different indicators, such as an oscillator, like the RSI, and trend lines, support and resistance trend lines, and Fibonacci lines, and candlestick patterns, because all of those indicators seem to measure the market from a different point of view. Candlestick patterns, well, that's a little bit more intuitive, a little more subjective, I should say. We have to analyze, okay, where did the candlestick go to? Did we close at a new high or a new low? Trend lines tell us the direction and tone of the market. Oscillators tell us the upward to downward movements. So, and Fibonacci is obviously percentage retracements and percentage projections. Now, another question. Any particular time frame you like to use with this method? Great question. Well, I would say, so a friend of mine once told me, the reason you get in the trade is the reason you get out of the trade. So if you enter the trade based on a daily chart, that's fine. That's a long-term trade. We have to use a long-term stop, and we have to use a long-term price target, a limit, and we have to always keep our decision process on the same time frame. Meaning you can't buy the euro dollar based on a daily chart, and then when it starts to go down, we say, well, let me look at a 1 hour chart. Then the 1 hour chart looks bearish, and then we can sell. We would sell to get out, take a loss, maybe sell short. That's where I think where traders run into a lot of trouble. So my point being is that if you start the trade based on the daily chart, exit the trade based on the daily chart. Now, other question, would you buy immediately after breaking above the upper trend line? The question is great. The answer is no, not yet. The foreign exchange market, due to the enormous amount of volatility, or not volatility, but volume in the market, I have found tends to be more range-bound in nature, meaning less of a likelihood of a breakout. I don't like to buy false breakouts. It really puts me in a bad mood. So what I would do, especially on longer-term charts, especially on daily charts where we have the time, what I would do is wait for the market to cross above and close above our resistance. I'll try to find some good examples of this. But what I'd like to do is wait for the market to cross and close above our resistance, and for that resistance to become our new supports. So if and when the market breaks above this resistance around 129.58, 129.60, actually hitting a high to 130.04, that's a big level, by the way, 130.0000. If we get above 130, I'll let the market go to 131, maybe 131.50. Then wait for the market to pull back. There's a precedent there's a tenet in the foreign exchange market that former resistance, if our resistance, which is our ceiling, this downtrending line over here, if that's broken, oftentimes it becomes our new support. Opposite also holds true. If support is broken, it oftentimes becomes new resistance. So what I would like to do, don't buy the breakout before the breakout occurs. What I would like to do is wait for the market to cross and close and really break above our resistance. Then I want the market to show us that the market has now formed a new support level, that our former resistance is new support. I'll try to find some good examples of that. I think it's very important. In fact, I have one here that I will show you right now. Let me take away this line, and I will draw a horizontal line. Horizontal lines are very, very helpful, I found. Notice how the euro dollar comes down, down, down. We hit lows of 132.58 on October 10th. October 10th, by the way, is a big day. Remember, that was that first very significant low in the euro dollar. At any rate, the market hit a low 132.40, 132.58 on October 10th. We rallied back up. We came back down. Possible double bottom pattern, but now do we buy low? Well, maybe, but I'd like to see a bounce. Never bounced. We ended up crossing and breaking to new lows. From 132.58, the market went down to 123.28. not too bad, around not 3,000 pips, about 1,000 pips, but still very, very big move. At any rate, now the market rallies back up. Now on October 30th, we rallied back up and tested our former support. Remember this number, 132.58 was our support level. We rallied back up, 132.58, our new high, 132.97. That is only about 39 pips difference, if I did my math correctly. The market, the former support, became new resistance within around 39 pips. On a daily chart, that is pretty good. That is pretty good. You know, obviously in shorter term charts, we want to be a little bit more accurate. But based on the fact that it's a daily chart, we broke below support about 133, 132.50, rallied back up. 132.97 was our former support, became new resistance. At this point, I would sell short. Now it's scary because after this breakdown, we said, hey, we might have missed a trade. We broke from 132.5 down to 123.5 or 123.25. That's a long ways. But actually, the market gave us a second chance. I like to say the foreign exchange market usually gives us a second chance. It's a more gentle, more kind market. Well, from 132.58, former support, new resistance, actually 133, we came all the way back down, eventually hitting lows of 123.88, so the market did give us a second chance. That's why I like to wait. Wait for the confirmation, wait for the market to really tell us that it's time that we sell short or go long. Question, does double the Bollinger Bands give more clarity or not really? Double Bollinger Bands, I assume, Harley, you're referring to using a 2 and 3 standard deviation Bollinger Band. Some traders may use it. I have not found it particularly helpful, but that's just me. You know, some traders do have methods to use the Bollinger Bands in that sense, meaning using double Bollinger Bands. I don't like to. I like to try to keep things simple. I want to try to make money the easy way first. After we make money the easy way, then we can complicate things. But I only tend to use a 2 standard deviation Bollinger Bands. Just to answer your question. Why did you not take the line from the larger green candle? Moving from the highs all the way up here? Is that what you're referring to? That was Ed that asked that question. The highs all the way up to 148.64, that was on September 22nd. You can. It's a great question. I'm being watched here. This is great. You can. This absolutely is another method to draw. You want to draw the support and resistance lines to touch the highs and lows. Now, somebody, somebody did not ask this, but it is a very common question. Do I connect the support and resistance lines from the wicks, the long, thin parts of the candlestick, or the bodies? I like to use the wicks. I like to use the long, thin candlestick, long, thin lines on the top and the bottom of the candlesticks. For those of you not familiar with candlesticks, it's very simple to read. Basically, all we do is we have the thick part of the candlestick. Well, here's a good example. That's the body. The body measures the open to the closing price. The long wicks incorporate the low and high of the day. So the market opened at this point, at the bottom of the thick part of the body, traveled down to the lows, all the way down to the wicks, traveled all the way up to the highs of the wicks, the thin lines, and then closed at the top of the thick part of the body. Now, how do we know it went up? Well, because it's green. If it went down, it's red. So I like to use the wicks, the most extreme highs and lows, to connect our support and resistance. I just thought I'd mention that because it's a very common question. Now, getting back to your question though, connecting the resistance levels on this point, yes, that is the accurate way to do so. I have found that's also helpful as the trend progresses. Then I like to draw other support and resistance levels as follows. We can do so. We don't know starting out which method is necessarily going to be more effective, but it gives us levels, different price levels to consider. This is not the only tool. Obviously, I would want to use Fibonacci as well, but that's left for a different discussion. I don't want to complicate things that much. We have other webinars, by the way, on Fibonacci. I love that indicator. I'm going to go do another chart, if that's okay. I'll refresh my charts over here. Please let me know if you can't see that. we should see a pound-dollar chart just to give us a little bit of a different idea what trends and ranges look like. There's a question, do you use an oscillator on daily or intraday or on all time frames? It's a very, very good question. My taste is a little bit different than some other traders. Every trader has their own methodology. I'll tell you what I do. Please, obviously take with a grain of salt as I draw my support and resistance lines. What I like to do is start with a daily chart, long-term time frame, daily or maybe a weekly chart if the market's really moving a lot. I like to go back around 6 months or a year, look at the daily chart, which we've done here in the pound dollar, going back from about September, beginning of September. First of all, visually examine the chart and say, okay, I think it looks to me like the market's going down on any period of time, and we can determine, okay, the market is in fact going down. Draw our support or resistance levels. Now, downtrending markets again, so resistance is more important. Uptrending market, which we'll see after the pound dollar, we'll see the dollar Swissy chart, that is uptrending. Then I'll draw my support first. But again, draw the resistance and make sure the market has not crossed above this resistance yet. It has not. Well, downtrending resistance at the moment lies right around 150.75 or 147.93 pound dollar. So that's step number one. Notice I have not placed any indicators in here yet. What I will do in addition is draw our Fibonacci lines, and there's a number of different ways to do so, but that'll give me a rough idea where I think the market could find future retracement levels. Take away the Fibonacci lines for a moment though. Now, alongside with these diagonal lines, I also like to use the horizontal price levels. I had a conversation with a trader, actually a dealer of all people, and I asked him, I said, this is a long, long time ago. I met him somewhere and I said, how do I really trade the foreign exchange market? Tell me the secret. Tell me what I really need to know. And I was expecting this really complicated strategy, and he was going to tell me to do this and to do that, and hedging and options and so on and so forth. He told me, he says, the foreign exchange market, as opposed to other markets, like the stock market's commodity, it's actually very, very simple. He tells me, focus on horizontal price levels. Horizontal price levels, just draw these horizontal lines. It kind of makes sense if you think about it. If we look at General Motors stock, how do we really determine a valuation for General Motors stock? It's under $5 a share lately. Is General Motors worth than $5 a share? I think so. You may not. Is Apple stock worth 200 or is it worth 60? Is Google worth, 1,000 or 10? And we can see a lot of times our fundamental analysis deceives us. Fundamental analysis surely did not determine that Redback should have gone to 200 or Pips.com in the late 90s should have gone to 200. And of course, it did not determine that it should go to zero either. So fundamental analysis is hard. But in the foreign exchange market, these price levels mean something. Will I take a trip to Europe? Not with the pound, or not with the euro dollar in the 120s, not with the pound dollar, it's certainly 150s. Somebody from the UK, do they want to visit New York City? Sure. At $2.11 for every British pound, I think a vacation is definitely called for. So the foreign exchange market is, I think, a lot more, the price levels are a lot more tangible. They mean something more. Also, for every penny that the foreign exchange market moves, large corporations, Microsoft, General Motors, Toyota, they have to make decisions. Microsoft has offices outside the United States. Well, they have to pay their employees in British pounds or in euros or Australian dollars, you name it. They have to constantly think, where's the euro? Where's the dollar? How much? What's our liability? What do we have to pay? What are we owed? And that, I think, creates the foreign exchange market, creates the fact that the foreign exchange market is a lot slower and a lot more consistent. It also has to do with the volume that's involved. Central banks will intervene at certain price levels. The Bank of Japan has been known in the past to intervene when the dollar-yen gets near 100 or even 95. They haven't lately, not that I know, but they usually in the past have. So these horizontal price levels really mean something. If the pound dollar gets above 155 level, it means something. A lot more than it means to me if General Motors stock is $5 a share or $10 a share. What does that really mean? And that is doubling. I'm not talking about the pound dollar doubling. If the pound dollar doubles, we go from 148 to almost $3. That would be huge. But in order for the pound dollar to make a big move, it maybe only has to move 1 or 2 or 3 pennies. 10 cents is a huge move. So the horizontal price levels, you'll notice, getting off of my tangent over here, do oftentimes represent support and resistance levels. Notice the former lows of 167.92, October 10th. Remember, those are a big level. Well, we rallied, we sold off, breaking below the lows, new highs, 166.72. 166.72.92, only a 20 pip difference. Not too bad. If we take away these long candlestick wicks, and I know I mentioned I like candlestick wicks, but if we take them away for a moment, or we could include them, but we'd have to draw the line to our significant lows. This seems to make a little bit more sense. In this case, I like to use sometimes the wicks, sometimes the bodies, but it's not a lot. The lowest closing price was 155.34 on October 27th. We then rallied up 155.24, 155.33, only 9 pips higher. Well, the next lowest low that we see, most significant low over here, by the way, closing price is 146.64. Do we have a lower one? Yep, 146.64. So I would say if the pound dollar gets below this 146 level, what was support could be new resistance. Would I sell short? Sure, but not here. Probably near 155, 155 and a quarter. Which indicators, in your opinion, are leading? Well, I think indicators by nature. There's not really any sort of leading indicator in technical analysis. Now, fundamental analysis, that's a different story. You have jobless claims in the U.S. That happens every week. We have our non-farm payrolls. That's the first Friday every month. Leading indicators, we actually have a fundamental indicator called the leading indicators. A leading indicator is this. I think it's a little bit of an overused, but very, very important title. Leading indicator is if I were to go to Intel and AMD and all the big semiconductor companies out there, and I were to ask the guy that sits at the end of the production line and say, how many semiconductors did Intel make this month? And he would say, well, that's great. I'll tell you. I'm sure it's not a state secret. I'm sure it is. But they would say, well, we made 10 million semiconductors. And AMD says we made 8 million semiconductors. That would be a leading indicator leading into, well, I think that the semiconductor and the technology market is going to perform better next month. Or better yet, we could go to McDonald's and ask them, well, how much hamburger meat, how many bushels of lettuce and tomato did you buy? That can tell us, okay, how many hamburgers McDonald's projects they will sell next month. That's a leading indicator. Foreign exchange, technical analysis, I should say, whether it's a foreign exchange market or the stock market, I don't think there's such a thing as a leading indicator. None of our indicators, like the RSI or the candlesticks, really predict what's going to happen in the future. They just measure past time over past price. A horizontal line touches the bottom of the left chart and the wicks in the right chart. Is that acceptable and accurate? Well, yes. It's a great question, Ed. It's not a perfect science. I would say in this case, it's fine. Sometimes I will use the candlestick wicks. Sometimes I will use the bodies when using horizontal lines. Now, the diagonal lines, I will always use. The candlestick wicks. Okay, so I'll always use the candlestick wicks. Audio is good there? Okay, excellent. All right, if all of a sudden I break, I stop talking, please tell me. Excellent, thank you very much. So the bodies to wicks and vice versa is okay on horizontal lines, exactly right. On diagonal lines, only wick to wick. Now, that's my personal taste. Ask 2 more traders and you'll probably get through 2 or 3 more answers. The reason why horizontal lines, I like to only use, the diagonal lines, I only like to use the candlestick wicks is because I really don't want to get caught in a false breakout or a false breakdown. That's the difference. We use the candlestick wicks, but in this case, if I were to draw a line connecting the candlestick bodies, we could see I will adjust this line. There we go. We will see the possibility of taking a false breakout. So on the diagonal lines, only wick to wick. Here, just type it out so there's no confusion. Diagonal lines, only wick to wick. Horizontal lines, okay to use wicks and bodies. The market also will find levels of big consolidation of stop orders. So sometimes when the market hits one of our former highs, could be new lows or former lows, new highs, the market will propel just a little bit higher. Let's get to another chart. I have an uptrending chart in this case. Please let me know if you cannot see this. This is the dollar Swissy daily chart. It's been a very very consistent uptrending channel. Now we'll start first with the daily chart. By the way, I did not mean to miss the question. There was another question out there. Jose had asked quite a while ago, do you use oscillator on daily or intraday or on all time frames? To answer your question, daily charts, I don't like to use oscillators very much. I just don't think it's necessary. I like to try to keep things simple. Oscillators, I think, should be used to really fine-tune our entry and exit, to tell us exactly when's the best time we think to get in and to get out. And that I would use on a 1 hour chart or a 4 hour chart. Those are considered medium term or swing trading type of charts. 1 hour, 4 hours are really my favorites. But I would use the oscillators on the 4 hour, the 1 hour, and lower time frames than that. But daily charts, only trend lines. Now, what I really look for is, again, I mentioned this earlier, having these support and resistance levels fall in a somewhat parallel fashion. It just helps give us a little bit extra confirmation. It's not always going to happen, but when it does, boy, is it nice. Well, dollar Swissy uptrending channel. Let's see if we can look at our former highs and former lows and see if we can determine, would this have helped us? Draw a line here. Well, if I can connect it to the candlestick wicks, candlestick bodies, it's more or less the same if we go back to September 15th, 16th, 17th, that area. Notice this double top high, 112.78. Before that, 112.78. Perfect. Well, we broke above. We said, oops, we missed the trade. 112.78. We went to 114.86, over 200 pips. But then we came back, 112.78, long candlestick wick, down to 111.28, actually 150 pips below us. But notice, the lowest closing price was 112.20. That's the difference between the wicks and the bodies. And again, long candlestick wick. And I'll mention something about candlestick wicks. So you don't really have time to go through the 4,000 different candlestick patterns that are out there. There's a lot. But what's a very easy way to use candlestick analysis, notice if the market starts to give us long candlestick wicks where we think there's a support or resistance level. When the market went up to these high, 112.78, is that what I said? Yes. Then crossed back down, the long candlestick wick emerged, showed us that despite the buying pressure, the sellers took control and sent us down lower. We went all the way back down to 106.89. Then we rallied back up. Notice not a lot of long candlestick wicks. We broke the new highs. Beautiful. Now we came back down. The question in my mind now is, well, if this was former resistance, will it be new support? Let me look for candlestick wicks. So we have 1, 2, and then number 3 was a really big one. Number 4, and even if we miss that, look at another long one, all the way back on October 30th. The foreign exchange market gives us the second chance, so sometimes more than that. Question, when you trade, do you use market price or do you choose a price or range, and also when you'd recommend using limit if at all? It's a great question. I like to trade according to what the charts tell me, meaning the dollar Swiss right now is 120.46. I don't see any kind of trade. Well, that's not true. I'll show you a trade. But I don't see a fantastic trade. A fantastic trade in my book is if the dollar Swiss comes back down to our uptrending supports at 117.30 level, and then tests this level, fails to break below the big figure 117, and then shows the signs of a move back to the upside. If that were to happen, then I would love to go long. That is the ideal trade signal. I would place a protective stops below the recent swing lows. Below that trend line, here's a red line. That indicates where the stop should be placed. Not exactly. I just drew that way for visual purposes. But I'd like to go long, basically, and we can draw another line. I'll show you what I mean. After we notice, it's very, very simple. After we see, okay, 1, 2 times, well, the third time is our test. So I'll draw another line. We'll make this line green, just to differentiate between the different lines here. Okay, so the green line is my buy order. The white line is our support level. The red line is my stop order. I can move this a little bit closer up. Okay, now, do I just place a limit order and walk away? No. I want to wait for the market to test this white line and to show me proof that the white line still holds. You see, we knew the white line held as supports. The support level held back at 112.01, but that was October 30th. A lot has changed with the Swiss franc, and certainly a lot has changed with the US dollar between October 30th and December 12th. I don't know if the fundamental picture inside has changed. I don't know if there's a greater amount of buyers or sellers. So I want the market to prove it to me again. If and when the market pulls back, I'll literally talk to my computer screen and say, okay, market, prove it to me. Prove to me that this line is still important. If it does, if the market touches and then fails to break below, it can go up a little bit below. I don't want to see a daily candlestick close below that line, though. But if we hold there, then I'll feel a lot more comfortable to buy. That's the difference. I really want to give the market the extra chance to confirm our trade. Now, more than that, let's go to a 4-hour chart. Here's a dollar Swissy. We're still on dollar Swissy. We can go to different time frames and find different support levels. Longer-term time frames, longer-term trades. Short-term time frames, short-term trades. Connecting the significant lows, November 25th, and then the lows of December 4th, just a few days ago, that puts our intermediate trend line around 119.69. Let's make that a different color just so we can really separate the two. I'm going to make that a dark blue line. I know it's kind of hard to see in a black background. Going back to a daily chart here, we can see long-term trend line tells us a buying dollar Swissy, 117, 117.50 in that area. Medium-term trend line, 119.50. So I might give the market a chance to prove itself at 119.50, but if it doesn't hold at 119.50, then I'll step aside down to 117.50. Let's take a look at some other horizontal levels, see if that makes any sense. Significant highs, maybe new lows. Well, it did over here. To have a look at this. 118 highs November 4th became our new lows, 118.30 on November 25th. Not too bad, almost a month later. We can look at other horizontal lines, look at the highs from 114.86, October 6th. New lows, 114.82. Not too much different. That's October 24th. Notice again now, the market crossed below this low, crossed below our former resistance. We thought it was new support. It was once, but not again. We crossed below. What was important can still be important in the future. So when 114.88 didn't hold, 112.57 did. Now looking forward, dollar Swissy, another range-bound pattern, 122.86, basically the 123 level, 122.96. We'll call it 123. I like to gravitate towards the large round figures. 122.96, 123 level. Well, we have another suspected resistance level. If we get up there, I may be tempted to sell short a double top. But more importantly, I'd rather like to go long. Now, look for agreement between unrelated lines, meaning our uptrending long-term support level, remember, that's currently around 117.50, 118, it will be soon. Notice the former highs, 118 on November 4th. When these two lines intersect, it means a lot more. It also represents more or less our former lows of 118.30. So that's a lot of fun. Only have a few minutes left, so I want to make sure I get to some other charts that I had prepared. Please let me know if you cannot see this. You should be looking at now the dollar CAD. Now the dollar CAD, wow, has this been volatile lately. By the way, Harley, just to answer your question, if I wasn't clear before, do you use market price or do you choose a price or range, and also would you recommend using limits? I always wait for the market to come to me. Okay, we may want to buy a new plasma TV. The new plasma TVs, when they first came out, how much were they? $10,000, $15,000, sometimes more. I said to myself, I want to buy a plasma TV. I'm still waiting. I'm waiting for the prices coming down a little bit more. It's very tempting lately because prices are so cheap. If I want to buy a new computer, or if I want to buy a home, or if I want to buy a car, whatever big purchase I make, I'm going to wait for the best price. I like to buy a new car, but not now. I want to buy a new car when the price is right, just like the TV show. Well, same thing holds true in the foreign exchange market. There's no reason why I should chase this. There's no reason why I should rush out there and overpay for a plasma TV or some great new piece of technology before the prices come down. No, I'm going to wait for the hype to leave. It's the same thing as going shopping. We're buying the foreign exchange market. We're buying the dollar against the CAD in this case. I'm going to wait for the best price. Well, dollar CAD certainly did enjoy a tremendous move to the upside. I'll change this back to white over here, and we can see the dollar CAD basically sitting on a very steep uptrending support line. Sometimes when these lines are so steep, well, I don't like it very, very much because it shows the market's going up a lot, and it's really hard to maintain that. But have a look at this. The highest high, we see 130.15. That was on October 28th, 130.15. 130, well, that's close enough. 130.15. The second high, 129.82. Not too bad. Only around 30 pips difference. And then 130.06. Only 9 pips lower than the first high. First high was established October 28th. The third high, December 5th. That's over a month. That's a month and a half of trading, and we came with a 9 pips. What are the right prices? Well, it's a great question. The right prices, the market will tell us. If I want to sell short dollar CAD, that tells me to sell short as close as possible to 130. I don't like 130 though. I don't like to sell short dollar CAD. I think we go higher. Why? This is called an ascending triangle, an uptrending support and a flat resistance. That's what I want to look for. Where's the right price to go long? Well, near uptrending support line and recent lows, which by the way are 124.46 on yesterday, or 2 days ago, December 8th. What I want to do is place my protective stops below the support line, below the swing lows. So if I go long dollar CAD for a long-term trade, I want to place the stops below 124.46 with a good amount of breathing room to boot as well. That is true also. If you buy, depending on which trading platform you use, if you buy at certain times or you take a trade at certain times, what's going to happen is you're going to pay more because the spreads sometimes tend to widen. Now, I would not be too concerned about this if you trade the euro-dollar pair or the dollar Swissy or the pound-dollar. Those are considered the majors. Those are considered to be more active. The spreads are closer together. But if you trade the more exotic currency pairs, like the Kiwi yen or the CAD yen or the Aussie yen or the pound, Aussie pound, for example, that's a different story. That's a different story because those are not as actively traded, and therefore the spreads tend to be wider. So in this case, we have a trending market condition that turns into a range-bound market. And just to get back to the spread, just one more thing. I completely forgot to mention this. You know, again, when new economic news is released, the markets get very, very active, but they can get very, very active. And the next thing you know, the spreads widen. That means if I want to buy the market, I'm going to buy it, but I'm going to pay more for it because the market's further away. On the other side of the coin, if we place a limit order and we know we're going to buy at this point, or we're going to buy at that point, we're going to pay that price, we have a better chance of getting in without a wide spread, which essentially means we have a better stop order, better risk-reward ratio, better stop order to boot. And it's a very, very simple approach. So again, just to sort of take a step back and summarize, I know it's a little bit of a review for some, but start with long-term charts, daily chart, weekly chart. Determine the range. Determine the trend. Is it a trending market? Is it going down, 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 or up, 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 or is it sort of locked in a trading range? If it's locked in a trading range, buy low, sell high. If it's in a trending market, we can buy low or sell high, but always in the same direction as the current trend. Trend is your friend. Start our support and resistance levels, connecting significant highs and significant lows. Uptrending markets, support is important. Downtrending markets, resistance is important. From that point moving forward, we find the best spot to go and get involved, trading with the same directions of trend, and then to fine-tune our entry, we can move to the 4-hour charts or 1-hour charts, maybe even a shorter-term time frame to really try to pinpoint what's the best point to get in. And then we can use our oscillators. We can use an RSI or a slow stochastics or a MACD or a Bollinger Bands. I would pick one of those. I don't think it's necessary to use more than one. But my favorite indicators, support and resistance, candlesticks, Fibonacci, one oscillator. I think that's a recipe for a lot of success. I want to thank you all very, very much for joining us. By the way, if you have any questions, do not hesitate to contact me anytime at all, www.forexlounge.com. We host over 40 hours of live trading sessions per week, trade signals delivered to you SMS and email, and much, much more. Contact me there, www.forexlounge.com. I want to thank you all very much for joining us. Thank you very much to FX Street, always a fantastic host. Please see their calendar. I'll be back on the air very shortly at FX Street. But we wish you a great day, all profitable trades, a great week, and we look forward to seeing you.